The ROI channel, the channel that's obsessed with the art and science of return on investment. And today, guys, a brief, hopefully 10-minute or less update with regards to the eToro portfolio that I know a lot of you guys are copying. And so let's take a look at where we're at and what I think is going to occur over the next, call it 6 to 18 months. So we had a monster October up 11.09% with a fair stack of that being in cash. So obviously that's a great outperformance. When you come to investing in some of the cyclicals or the deep value plays, you're going to have volatility. I've said that all along. This is volatility on the upside, so it feels good, but there's nothing to say we won't have a few months where we're mark to market down on a double-digit basis. Another thing that I know I harp on it a lot, but it's really annoying because it doesn't take into account the dividend yield. So when you add that back in, and if you're a foreign investor investing outside of the US, your foreign exchange will add back quite appreciably to the returns. Anyway, having said that, I'm a popular investor on eToro. If it's the first time to the channel, I'll leave a link in the description and you can obviously go and take a look. And if you want to copy with some funds, great. If not, add me to a watch list and like and subscribe to the channel for lots and lots of great free information. Disclaimer, I'm not a financial advisor, okay? None of this is advice. It's just my opinion and what I am doing with the coins that I'm in charge of. That's it. So the rest is up to you guys. Let's take a look at where we're at. So year to date, I just realized that I had my setting in Spanish. Doesn't matter, guys. Year to date is the most important thing. The S&P 500 at last close, 3,770 down 21.39% on the year. Okay. So obviously very poor year for broad equities. We knew that was going to be the case. I've been talking about that for a very long time, showing how the S&P 500 is really only 5 companies, and you're just paying ridiculous amounts per every dollar of free cash flow. And so I don't see how, even today, with the index being marked down 20%, you are going to get any sort of decent return from that. And I think that Apple in particular is probably the worst offender. I was flirting with the idea of shorting Apple. I'm not going to do it. I'm going to use cash as our hedges to reduce volatility. So year to date, the fund has outperformed the S&P by 7.43%. So that's our alpha. When you hear about alpha, it's in this case for me, my benchmark is broad equities. And so I use that as the yardstick against which I'll be measuring the investment performance. And we have outperformed that by 7.43% so far year to date. Okay. It won't be linear. Again, there'll be a lot of volatility. This is what I want to achieve over the long term. And if I could do that to this degree for many years, I would be very, very happy indeed. Okay. So let's take a look at the performance so far this year. So we are down 13.96%, and we had a shocker over June because energy sector got hit, and rising interest rates, people suddenly realized that the Fed was serious about tightening monetary policy. And so there's a broad market sell-off. I had remained too long in certain positions outside of the energy sector, and I decided to cut the losses. I cut Warner Brothers Discovery, Royal Mail, Micron, Overstock, because although there was a valuation case to be made, I felt like it was just time to cut the cord and there were better opportunities elsewhere. And so I made the hard decision to do that. If I had have not entered those and stuck with my original thesis, basically being more confident in myself, I think that you could add easily close to 10 percentage points back to performance. So it'd likely be flat to slightly negative, probably flat when you take into account the dividends and the foreign exchange. But that's a lesson for me to learn, is to not be pressured by other people talking about portfolio management theory and all this sort of thing. Go into those sectors that have been beaten down and just make sure that I educate the investors and the copies and saying, look, there's going to be volatility. We're going to have some very ugly months. That's the price we're going to pay for outperformance over the long term. And so that's a big, big lesson, and one thing that I will be not repeating in the future. But having said that, we have the rest of November and December to come, and I think it's going to be a monster rally for energy. I really, really do. Everything else I think is going to get smacked pretty hard. As such, down here, I've given you a very simple overrun of how the portfolio is positioned. We are at current weighting 54% in the energy sector, and that's broken up between uranium, played by the URA ETF, coal, mainly met coal. We did have some thermal coal, but there was an arbitrage between the met and the thermal coal. So I had sold down the Whitehaven and moved it into or increasing the percentage weighting of Arch Resources, more sort of your met and coking coal. Metals and materials, we're just under 12%. I would love to be able to increase that. Eventually, what I'd like to see is get the metals, base and precious metals, to around 20%. But I think that we need to wait for that, and I'll explain why in a moment. General equity is still sitting about 3%. There are a couple of exceptional value plays out there that I think fit the description of the type of business that I want to own in this secular inflationary environment, being capital unintensive, asset light, clip the ticket royalty businesses. GoPro, I believe, is one of those. Very, very unpopular. I think people just aren't paying attention to the way they've changed the business structure. StoneCo down in Brazil, some crazy stuff going on in Brazil, but it still represents phenomenal value. I mean, nearly 30 to 40% top line growth is certainly achievable. And we've got a tiny position in American Express, but it's nothing to speak about. Agriculture is just under 8%. I would love to up the ante. They've run so much on me. I clipped the position in CF Industries last year, and the profits have run back up again. So again, I'm regretting listening to these MBA portfolio managers. I should have just stuck with my guns, and we'd be sitting on a 6% weighting that ran over double. And so obviously that's going to add 6 percentage points back to the portfolio percentage. But I didn't. I took profits too early and I redistributed it, and I won't be doing it again. Simple as that. Cash, we are sitting on a heap of cash. It's actually a little bit more than that, based off a few positions I sold down this morning. So there we are. Main industry exposure is to oil. So if we just take a quick look here at where we're at year to date in terms of performance and where we're at in terms of valuation, top part is performance. Okay, so these are how the sectors have performed, whether the price went up or down, and by the percentage. Okay, very, very simple. Energy has been the number one performer. You shouldn't be surprised if you've been watching this channel. I've been shouting that from the rooftop, saying what I thought about that. People ask me, has that train already left the station? And I don't believe so. I think we're getting close to about not even 5% of the S&P being weighted into energy, and yet it's making more than 10% of the earnings. Historically, anywhere between 15 to 20 would be at the highs for the percentage of energy representation in the S&P. And so I'm not looking at betting against the trade or exiting the energy thesis until we get to those levels and we see CapEx numbers really start to increase. So we'll talk about that at another time. Tech's been smashed, communication services has been smashed, consumer cyclical has been smashed. Yeah, no real mystery as to why that is if you've been watching the channel. So where are we now in terms of valuation? So in this different sectors, how much are you paying for every dollar of free cash flow? So consumer defensive, people think with the recession coming, they're just blindly piling into consumer defensives. Well, guess what? It matters the price that you pay. So if everyone piles in there and the price gets bid up and you're paying too high a price, you still may not get a decent return. Okay. Especially when you look at the earnings per share expected over the next 5 years to compound or grow at only 8.76%. That's barely going to keep up with inflation. In my opinion, it won't keep up with inflation. So I'm not interested in that. If we go all the way down where the cheapest parts are, guess what we find? Financial and energy. So you're paying $11.47 for every dollar of free cash flow for the energy sector across the board. We can do a lot better than that if we dig deep. And so that's why I've taken several individual positions in the sector. And the earnings are expected to grow at 17.36% over the next 5 years. Okay, so that's where we want to be. People have asked me about financials. I have no idea what sort of tail risks are in these banks. They're trading at big discounts to their books, but I don't want to touch them. I personally, just for me, I find it very difficult to value banks. It's not my area of expertise. Fintech is different because fintech, provided they have a monopoly, like StoneCo in Brazil, for instance, they're sitting on an absolute growth runway where they've got payments going up, fixed expenses staying as they are, variables only going up slightly. And so that huge discrepancy between the expense column and the revenue should provide for a very, very healthy margin indeed. So asset light financial technology companies, there may be some special situations, and I believe that StoneCo is one. The rest, healthcare is The next one I would be interested in, it's still not very interesting yet. Basic materials, I really want to get a hold into. However, if we do have this recession depression for 1 to 2 years, your basic materials and base metals like copper, etc., are going to get, they're going to be very unpopular. So they're not going to do anything worth investing in. However, on the other side, if we have a complete 180, they'll be exactly where a lot of the alpha will be. So a bit hard to tell. And so I'm just keeping an eye on it. We have positions in some base miners and construction companies, or materials companies, I should say. And so again, I'm just slowly building out those positions as we go. And I'm really waiting for a green light as to what's going to happen in terms of monetary policy before we start to increase that weighting. Precious metals, same kind of deal. Although they've been beaten down so much, I would be reasonably happy to continue to build out some more exposure to the likes of the Barricks of the world that are paying roughly 10% free cash flow yield for one of the world's best precious metals miners, and just increasing some exposure to bullion instead of holding it in cash. Themes to watch. Okay, so US dollar strength, that's been the talking point of the last quarter. Reversion to the 200-day moving average. I've mentioned that before as a signal where I will start to change some of the positioning, and I will start to heavily increase weighting to emerging markets with promise that are net energy exporters, or at least self-sufficient. So really Brazil, potentially Colombia, depends what happens with the politics in those countries. So there's a crisis and opportunity there. India, I don't like because they're so exposed to energy imports. However, they do, as far as I'm aware, have a decent amount of refining capacity. So be interesting to see. Oil prices, I think that they are going to be in that range that I've mentioned. If you watch the podcast with Shubham Garg from White Tundra Investments, we can see crude plus the refining margins, so crack spreads. I think the floor will be around $85 to $90. So we're just ticked over $90 as of time of recording for crude. And I think that plus a normal margin of maybe $20 to $30, we'd expect 120 for that crude plus crack spread. And I think that could get up to as high as 185, which if you take $20 to $30 off that is somewhere around 150, is not out of the realms of possibility for crude oil. Which means that our positions in the energy sector will fly. The Fed funds rate, will it reach 5%? A lot of conjecture around that. Quite possibly, but gee, I think they'll be pushing it to move any higher than that. If they do that, we will see some significant pain in that top-heavy sector. And what that means, initially, you start to think, well, it doesn't bother us because we're not invested in there. Now, that's true, but the problem is other funds are, and they will have some holdings in the stocks that we own. So they will get called if they're on margin, or they'll be forced to liquidate. And so you may just get this broad sell-off for a relatively short period of time where they just have to sell things to raise the collateral to make good on their margin calls, which means some of our positions might get smacked down. That'll be a chance to get in at even better prices, or to increase positions. So my gut feel, and obviously I can't know this for sure, but my gut feel would be if you get the Fed funds rate topping at around that first quarter, so maybe the end of March 2023, maybe the second quarter, but I think we're in for a lot of pain if that is the case, then I think is the big opportunity to load up on the cyclicals, the Vales of the world, because you will have this depressed growth scenario, depressed demand for their products, and their currency will be really, really under strain against this rising dollar on the back of the Fed funds rate. And I think then will be a time to really increase those weightings to the point where eventually US tax receipts are not sufficient to cover the liabilities. And so the Fed finds it, or the Treasury finds itself in a predicament where they really can't make good on the debt. There's a lot to be said about that. I know I'm simplifying it. I know there are nuances, but eventually they will have to do something, some sort of a pivot. And whenever that comes and whatever that looks like, then I think you will see the precious metals really start to turn the corner. And so we want to be positioned accordingly. Okay, so mistakes and bad luck. I've mentioned that. I think Micron was a little bit of a bad luck, maybe a mistake, but I think there's a lot of bad luck involved with Micron. I purchased it at a discount, or a very cheap valuation to its book value, and it really has a very strong position. It's not easy to build out these refiners. And then, of course, we have problems with China and Taiwan, and the US has just thrown a gazillion dollars at semiconductor manufacturing back onshore in the US. And so I have this horrible feeling that I was finding myself at the top of the CapEx cycle, and that is definitely not where I want to be. And I think that there may be a cyclical flooding of the market for chips. Might be wrong, but I figured to cut the losses. They weren't terrible losses, so we had a better opportunity cost in the energy sector, and I rolled that across. Overstock, I just think it was a mistake. I might be proven wrong. That I had good reasons to enter it, but I think I should have just stuck with the simple thesis of what I'm good at in my area of comfort. Royal Mail, still a cheap stock. Not a terrible idea, but inflation and all the rubbish that's going on in the US. This is an example of the micro bottom up being okay. It wasn't a bad investment, discount to book value, lots of cash on the balance sheet, all that sort of stuff. Would have been fine, but the problem is the macro. So it's a good house situated in a bad street. And with everything that's going on in the UK, the mismanagement of the government, the finances, and the UK, the Great British Pound being smacked, I think those forces are going to be too strong to overcome the fact that it's still okay. Not a great investment, but it's not bad. But we can't accept that. We have to do better. Simple as that. So where's the evidence of the thesis playing out? I've been talking about this a little throughout all the macro updates. And let's just take a look at a few things that do give us some confidence that we are on the right track. So the energy sector performance that I mentioned is still not close to that 10% S&P valuation. So we've done very, very well from that standpoint, but we've got a lot more to go. The portfolio this month in terms of dividends yielded 1.51% in dividends alone, so just dividends. And if you add the Forex onto that, in Australia, that's probably about a 2% performance just on the dividends. Very, very good. So then obviously it's not going to stay this way, but annualized at time of recording, that's about 18.12% dividend yield, which is very, very good from a dividend alone. Now, obviously that yield won't stay the same if we have a somewhat efficient market, because money will start to flow in and that yield will be compressed. And that's exactly the point. We buy these cheap stocks so that when that happens, we get the equity gain on the upside and we can hold and enjoy the cash flow, or we can roll that into other opportunities. That's exactly the point. Growth versus value sentiment. I've talked about that from the money flows. Scott from Sovereign REIT Capital did a great presentation. So go and watch that video about money flows. And we're seeing it. We've seen the tech sector roll off. The tech sector is down 30%. The energy sector is up 46%. What more do you need to say? ESG rhetoric softening. People are realizing that ESG is just a bunch of grifters and politico speak. And so we see the rhetoric start to change. All of a sudden, Germany is quite happy to burn high sulfur lignite coal. Yeah. So the next thing that we've heard is that uranium is back in or nuclear power could be back on the table. All these things that we've spoken about just takes time to sort of condition the sheep out there, the voting sheep, the voting flock, to be able to vote in the right direction for where the powers that be want to go. And so, yeah, we'll keep an eye out for that. Next thing I could see is that offshore being considered much more green, and because there are a hell of a lot less carbon emissions from offshore drill space, which is why it's one of my favorite space. Institutional capital flows, we're starting to see enter the sector. So all these things are playing out exactly as I've spoken about over the last year to 2 years. So my vision has been very good. Execution could use a little work, but hey, I'm willing to go back to the drawing board, figure out where I went wrong, and continue to put that back into perspective. Having said that, we've outperformed the market by 7.43% so far. So just need to take that in the stride and make sure continue to do better in the future. Thank you for watching. Please make sure you like and subscribe. Link to the portfolio will be in the description, and you can hit me up on Twitter. I'm getting more and more active. I'm really enjoying the space. Thank you so much for watching. I'll be back with another video hopefully soon. Oh, join the ROI Club. Nearly forgot to sell you on my very expensive membership program here. What it is a private club where I give out my analyses for my very favorite stocks. You get monthly macro analysis and article, and I go into a deep dive and giving evaluation on one particular opportunity. You also get access to some of the options trades that I am doing, and you get access to all my intelligent nodes, so exclusive interviews with professional investors, and I have a tally of stocks that I follow that the valuations are constantly being updated. So not very expensive, guys. It's $5 a month if you pay annually. So so far we've had people certainly consider that to be well worth their investment. They've made a lot more than their money's worth so far, which is great. That's it, guys. I'll leave the link to this in the description also, and hope to see you on the other side enjoying everything that the ROI Club has to offer. Thank you.